afternoon. My name is Yolanda Vacha. Governor, Deputy Governors, members of the media, financial sector stakeholders, and everyone joining us virtually, a warm welcome to the second Financial Stability Forum of 2023. The Financial Stability Review is released every 6 months and reflects on conditions in the financial sector. This edition covers the period from June this year to date and identifies and assesses risks to the financial system in the coming 12 months. This afternoon's proceedings will kick off with opening remarks from the Governor. Dr. Herko Steyn, lead macroprudential specialist from the Financial Stability Department, will then take us through the highlights of the Financial Stability Review. At the end of his presentation, you will have an opportunity to pose questions to the panel members via the platform. Please note that when you pose your questions, if you could kindly identify yourselves using your name and your organization. Also, at the end of Herko's presentation, we will have the FSR made available to everyone online, so you can please download it on the SARB website once the forum is finished. Ladies and gentlemen, I will now hand over to the Governor for his opening remarks. Thank you.
Good afternoon and welcome to the second Financial Stability Forum of 2023. This forum allows us to unpack how global and domestic economic developments affect the domestic financial sector, which is the basis of the Financial Stability Review released today. The latest Global Financial Stability Report of the International Monetary Fund notes that the possible spread of stress in the US and European banking sectors in the first quarter of 2023 has eased. Inflation moderating and an easing in financial conditions globally are core themes in the second half of the year. However, inflation surprises, lingering concerns over China's growth prospects, and renewed concerns about global debt sustainability could lead to a repricing of assets. As evidenced by the sharp increase in the global bond yields in September and October, global financial conditions can tighten unexpectedly. Risks to the global growth remain skewed to the downside as inflation remains elevated and interest rates are set to remain higher for longer. The effects of higher interest rates are becoming apparent, notably impacting the repayment capacity of corporate and household borrowers. Looking back at 2023, the year has been characterized by higher interest rates in advanced economies, uncertainty about economic growth trajectories, and constrained fiscal positions. Yields on 10-year government bonds in advanced economies have increased significantly relative to emerging markets since the release of the Financial Stability Review in May 2023. This has contributed to a reduced yield differential between advanced and emerging market economies, in turn dampening investor appetite for emerging market sovereign debt. Domestically, systemic risk has remained elevated since the release of the May 2023 Financial Stability Review, albeit that some of the underlying contributing factors have changed. Similar to other emerging markets, rising fiscal risk has been flagged as a financial stability concern in South Africa, given government's increasing debt levels and associated higher debt service costs. The impact of being on the Financial Action Task Force's grey list also continues to be felt. Systemic risks that have subsided somewhat include the decrease in the risk of secondary sanctions being imposed on South Africa and the potential easing of electricity supply constraints following a marked increase in new electricity generation projects registered with the National Energy Regulator of South Africa in 2023. This edition of the Financial Stability Review provides an overview of the results from the SARB's 2023 Common Scenario Stress Test. The exercise covers the 6 South African banks designated as systemically important financial institutions, representing 92% of total banking sector assets as at 31 December 2022. The common scenario stress test is a macroprudential bank stress test used to identify any risks and potential vulnerabilities. This is achieved through the assessment of participating banks' resilience to severe adverse macroeconomic scenarios. While the common scenario stress test also assesses the health of individual financial institutions, the ultimate objective is to determine whether the identified vulnerabilities could compromise the stability of the broader financial sector. The results confirm that systemically important banks remain well capitalized, sufficiently liquid, and are able to withstand the severe shocks simulated under the adverse scenarios of the exercise. The liquidity stress test results also confirm that the participating banks maintain strong liquidity buffers, again well in excess of minimum prudential requirements. At its October meeting, the SARB's Financial Stability Committee resolved that a positive cycle neutral counter-cyclical capital buffer of 1% be implemented in South Africa. This will be phased in from the 1st of January 2025 and will be fully implemented by 31st December 2025. Overall, regulated financial institutions in South Africa remained resilient in a challenging environment, as measured by their ability to maintain adequate regulatory capital and liquidity buffers. The domestic financial system continued to function without disruption. So we are in a pretty decent space. I would now like to hand over to Herco Steyn, who will present an overview of the FSR, and after which we shall take questions.
Thank you very much, Governor, and a very good afternoon to all our listeners. Just waiting for the slides to come up. Thanks so much. So one of my colleagues always says there are three certainties in life: death, taxes, and definitional issues. So on the seemingly trivial but actually critical issue of defining financial stability in the South African context, the SARB's definition firstly focuses on the crucial importance of there being broad and deep-rooted confidence in the financial system, and secondly on the system's resilience to systemic risks and shocks. The pursuit of financial stability is therefore perpetual as new risks are always emerging. The SARB's primary mandate of achieving and maintaining price stability is enshrined in South Africa's constitution. In addition, the Financial Sector Regulation Act 9 of 2017 gives the SARB a statutory mandate for protecting and enhancing financial stability. Delivering on this statutory mandate requires a two-pronged approach. The first relates to monitoring and identifying risks and mitigating them to the extent possible. However, not all risks can be readily foreseen, and, as COVID-19 demonstrated, shocks will always occur. This is where the second component of resilience becomes pertinent. Delivering on the SARB's financial stability mandate does not mean all shocks are prevented, but rather that the financial system is sufficiently resilient to absorb the impact of shocks. Although the Financial Sector Regulation Act assigns a lead role to the SARB in protecting and enhancing financial stability, it empowers several other financial sector regulators as well as the National Treasury to support the SARB in pursuing this mandate. The SARB cannot deliver on its financial stability mandate on its own, and interagency collaboration and cooperation are therefore crucial. Then moving to the key global developments since the release of the May 2023 FSR. Seems the slides might have gotten stuck. There we go. So in terms of global developments, yields on 10-year government bonds in advanced economies have increased significantly since May 2023, given lingering inflation concerns and expectations of higher policy rates for longer. This makes emerging market government bonds relatively less attractive. Financial markets appear to have adjusted to a new normal environment characterized by high interest rates in advanced economies, differences in economic growth trajectories across jurisdictions, and constrained fiscal positions globally. These factors combine to reduce yield differentials between advanced and emerging economies, in turn dampening investor appetite for emerging market sovereign debt. While indicators suggest that interest rates are at or near their peaks, there are factors that could undermine the moderation in global inflation, including high energy prices and ongoing geopolitical tensions. Additional policy tightening may tip the global economy into a recession, dampen appetite for riskier assets, and expose financial vulnerabilities. From an emerging market perspective, idiosyncratic factors increasingly lead to diverging inflation expectations and policy rates. This, coupled with the slower than expected Chinese recovery and the higher for longer outlook for interest rates, continues to weigh on global investor sentiment and risk appetite. Some of the key risks to global financial stability include the ongoing and possibly increasing geopolitical tensions. Among other implications, such tensions have slowed globalization and integration of supply chains and financial markets across regions. This has manifested in friendshoring or nearshoring, which exacerbates the risk of fragmentation across countries, regions, and financial markets and systems. Generally, emerging markets tend to be most negatively affected by a slowing or reversal in globalization. The risk of policy rate divergence materializing in 2024 could lead to increased financial market and capital flow volatility, which generally have negative implications for emerging markets. Inflation surprises, the slower than expected Chinese recovery, and growing concerns globally over the commercial real estate sector could negatively impact investor sentiment, with detrimental implications for emerging markets in particular. Then moving to domestic developments related to financial stability. So as commodity prices eased from post-pandemic highs, South African tax revenue was below projections. Combined with higher government spending, this led to faster than expected growth in government debt this year. South Africa's public debt stood at 72.7% of gross domestic product in the second quarter of 2023, which is notably above the emerging market average of around 50%. The increasing borrowing requirement to finance the widening fiscal deficit could result in a higher than projected gross loan ratio of 72.8% of GDP for the 2023-24 fiscal year by National Treasury. Higher levels of government debt in a higher interest rate environment mean higher debt service costs. Government's debt service costs have more than doubled since 2008, further crowding out growth-supporting expenditure. The share of debt service costs to main budget revenue increased markedly from 14.3% in 2018-19 to 20.7% in 2023-24, which is well above its long-term average of 13%. Government projects that its debt service cost will settle at 22.1% of main budget revenue in 2025-26 and at 5.4% of GDP before easing. While government debt and debt service costs have been increasing, non-resident investors have continued to gradually reduce their relative holdings of South African government bonds and equities. Foreign investor participation in the South African government bond market has declined steadily since 2018, with an acceleration following South Africa's exclusion from the World Government Bond Index in April 2020. The holdings of South African government bonds by non-residents continue to decline to 25.4% in October 2023 from 38.7% in May 2019. South African capital markets have continued to record investment portfolio outflows. The equity market has suffered the most. The equities market has suffered the most net outflows as foreign appetite for domestic equities has been weighed down by low growth expectations, rising interest rates, heightened exchange rate risk, and idiosyncratic factors such as the fat of grey listing and load shedding. As may be observed from the graph on the left, growth in banks' holdings of government bonds has far outpaced growth in total assets in recent years. This disproportionate increase implies a change in the composition of bank balance sheets as investment in high-yield government bonds become more attractive than other assets. Moving to the graph on the right, it shows that the proportion of banks' risk-weighted assets to total assets has declined from around 52% in 2019 to around 46% currently. This reflects the fact that government bonds carry a zero or very low weighting for credit risk and therefore also requires little or no capital to be held against them. This provides a further incentive for banks to increase their exposure to government debt, especially in an environment of low growth and rising credit risk. However, it is not only banks that have increased their holdings of government debt over the last few years. Other non-bank financial institutions, most notably pension and investment funds, have increased their exposure to South African government bonds considerably over the past few years. The combined effect of higher government debt levels and the lower appetite for South African government bonds by foreign investors contributed to the higher holdings by domestic investors. The effect on the financial system is increased concentration, less diversity and low liquidity in the bond market. From a financial stability perspective, this vulnerability could lead to a negative feedback loop between the sovereign and the financial sector. This is commonly referred to as the sovereign financial sector nexus, as discussed in this edition of the FSR. Then commercial real estate remains under pressure, among other factors due to rising municipal costs, above inflation increases in property taxes, water scarcity, electricity shortages, and environmental challenges such as floods. These factors are pushing up expense to income ratios, and reflecting these factors, share prices of South African real estate income trusts have been on a downward trajectory since 2016, underperforming relative to the JSE All Share Index consistently since then, as per the graph on the right. And as may be seen from the graph on the left, households and non-financial corporates are starting to exhibit some strain, as evidenced by an uptick in non-performing loans. As interest rates increase, so does the financial stress on bank customers, which, with some lag, continues to increase non-performing loans. The credit quality of the banking sector's balance sheets has started to deteriorate somewhat, as per the graph on the right, with the non-performing loans accumulating across both corporate and retail portfolios. This risk is elevated for loans originated during previous years of low interest rates. However, banks generally manage their credit risk well by increasing provisions as non-performing loans increase. The SARB continues to monitor these signs of increasing credit risk across the domestic financial sector closely. Then, against this backdrop of key global and domestic financial stability-related developments, we move to the outlook for financial stability as depicted by the SARB's Risks and Vulnerabilities Matrix, or RVM. The RVM is a forward-looking assessment of the key risks to financial stability in South Africa over the short, medium, and longer term. Key risks are identified based on the current conjuncture as just discussed and take into account possible future developments and the vulnerability of the financial system to such developments. 3 risks have been rephrased or removed from the RVM since the May 2023 FSR. The risk of secondary sanctions being imposed on South Africa has decreased notably. However, the fallout from the intensification of geopolitical risks more broadly remains pertinent, and this risk has been reworded to intensification of geopolitical risks in this edition of the FSR. The risk of a cyber attack or a successful cyber attack remains ever present, like several other operational risks that could cause a systemic disruption. Similar to other risks, increasing cyber resilience requires continuous investment in mitigating actions and factors. Then the structural risk of slow and inequitable domestic economic growth has been on the RVM for several editions of the FSR and has been rephrased as persistent growth impediments. The RVM in this edition of the FSR therefore looks as follows, with country-specific risks discussed on the next slide. So on a sharp repricing in government debt, the financial sector's exposure to government debt increased markedly over the past decade, while at the same time the fiscal position and the credit rating of South African government debt deteriorated. This poses various risks for financial stability, most notably through the repricing of bonds when yields rise, resulting in both realized and valuation losses on holdings of government bonds, and through the possible crowding out effects of a large amount of government debt that increasingly has to be funded in domestic financial markets. Then with regard to capital outflows and declining market depth and liquidity, although the challenge is not unique to South Africa, it remains one of the most pertinent risks to domestic financial stability, especially if considered alongside the sovereign financial sector nexus. The impact of an insufficient and unreliable electricity supply has prompted large-scale private sector investment in alternative energy solutions. While the full benefits of these reforms are likely to fully materialize over the next 3 to 5 years, some improvement has been noted this year, leading to a slight decrease in this risk from a financial stability perspective since the May 2023 FSR. New electricity generation projects, primarily by the private sector, registered with the National Energy Regulator of South Africa, have increased to 4,126 megawatts in the year to October 2023, compared with 1,664 megawatts for the entire 2022. South Africa's addition to FATF's list of high-risk countries in February 2023 requires that financial transactions with the South African component are subject to enhanced due diligence. While the immediate impact is high processing, monitoring and reporting costs, the long-term consequence will be the reduction of South Africa's attractiveness as an investment destination. However, the risk is mitigated by the resilience of the financial sector, compliance with international regulatory standards and the efforts being made to address the adverse findings of the FATF by the February 2025 deadline. There are several factors that contribute to the risk of persistent structural growth impediments. Infrastructure degradation, most notably of railways, ports, water and electricity, limits potential and actual growth. Years of slow and inequitable growth raise the risk of social unrest, which in turn may negatively impact on investor confidence, funding costs, insurance claims and operational costs. Finally, with regard to the possible further deterioration of household and non-financial corporate saving buffers, should inflation flare up due to events beyond South Africa's control, for example, higher energy and commodity prices as a result of an intensification of geopolitical risks, the forecast decline for inflation may not materialize and may necessitate further policy tightening. The longer interest rates remain high, combined with cost of living increases, the more borrowers will experience strain. This could manifest in non-performing loans or in rising non-performing loans and payment lapses, which could reduce capital and profitability in the financial sector. Against this backdrop, I move to the SARB's assessment of financial stability conditions since the May 2023 FSR. Systemic risk remained elevated during the period under review. The most notable factors that contributed to systemic risk since the release of the May 2023 FSR include governments increasing debt levels and the concomitant higher debt service costs, domestic financial institutions' high exposure to government debt, and implications of being on the FATF grey list. Developments that contributed to a moderation in systemic risk include the decrease in the risk of secondary sanctions being imposed on South Africa, encouraging developments around the potential easing of electricity supply constraints in 2024 and beyond, and reduced concerns over the global banking stress observed in March 2023. Although prudentially regulated domestic financial institutions in aggregate remained resilient, there are signs of increasing credit risk across the financial sector, which is being monitored closely. Persistent structural growth impediments, tighter for longer global financial conditions, and other idiosyncratic country factors will likely test this resilience beyond the forecast period. Then moving to the initiatives and policy actions taken by the SARB to enhance financial stability since the May 2023 FSR. At its meeting in October 2023, the SARB's Financial Stability Committee resolved that a positive cycle-neutral capital buffer of 1% would be implemented in South Africa, with the phase-in period being, the phase-in period will start on 1 January 2025 for a period of 12 months and is to be fully implemented by 31 December 2025. The Prudential Authority published a draft directive to this effect on its website on Monday. And then the SARB's Financial Stability Committee also resolved that the sovereign bank and sovereign financial sector nexus do not require formal policy intervention at this stage, but that the Prudential Authority is to develop ways to monitor and close valuation gaps in banks' holdings of South African government debt. The SARB further continued to collaborate with Financial Stability Committee or FSOC members to discuss some of the key risks to financial stability, in particular the way forward following South Africa's grey listing by the Financial Action Task Force and the addition of South Africa to the European Union's list of high-risk countries. Through the Financial Sector Contingency Forum, the SARB also continued to plan for the improbable, but not impossible, scenario of a complete national electricity grid shutdown or other potential systemic event. Then in closing, Chapter 3 of the FSR is again dedicated to selected issues of direct relevance to financial stability. In this edition, Chapter 3 in the main focuses on the results from the SARB's 2023 Common Scenario Stress Test. I could not do justice to the inordinate amount of work that went into the 2023 CSST or Common Scenario Stress Test in a few slides, but the SARB stress testing team worked through, collected, collated, and analyzed almost 250,000 data points in producing the contribution to the FSR, and I therefore encourage you to read the dedicated write-up on the results of the stress test in Chapter 3 of the FSR. Overall, however, the results of the 2023 Common Scenario Stress Test confirmed or indicate that domestic systemically important banks will be able to remain well capitalized when faced with a set of severe but plausible scenarios. And with that, I thank you for your attention, and I hand back to the Governor for Q&A. Thank you.
Governor, we have two questions, and I think I have a third one as well. So I'm going to just read the three questions for you. So the first question, Governor, is the Corporation for Deposit Insurance still on track to become operational in April next year? Second question that we have is that we have a deadline of 2025 to get off the FATF grey list. Are we confident that we are able to comply, given that some of the challenges identified in the report include our inability to prosecute financial crimes? And then the final question for this round, Governor, says the FSR speaks of the financial sector increasingly exposed to government debt, and there are no signs that it will be contained. It's already doubled in the past 10 years. What is the message to financial institutions should government not be able to contain the debt? Thanks, Governor.
Thank you very much. Yes, Cody is on track for the 1st of April next year. We can confirm that. The team is working diligently to make sure that we are ready, and we think that at the moment we do not see any other hindrances. We should be able to make it. FATF grey listing. Yes, we have set ourselves the target of 2025, and I think that in the most recent plenary meeting, South Africa demonstrated significant progress in addressing the shortcomings that were identified by FATF. Yes, there are risks that we might not have addressed all of them by then, but that is not our baseline scenario. Our baseline scenario as a country is that it's all hands on deck. We are working hard to make sure that we get off the grey list by addressing all of those concerns raised by FATF. Exposure of the financial sector to the government. The only way in which that is going to be reduced is if government continues on the fiscal consolidation path that it had announced. And I think that it is very important here to note that our concerns here are that as it stands, it is attractive for the financial sector to buy government bonds and earn these generous yields from government bonds instead of investing in companies and sectors that, as you heard from the FSR, where we talk about them and risk-weighted assets, that is, they should be extending loans to the private sector rather than to the government. In simple terms, we would say that we are concerned that government might be crowding out the private sector out of the funding markets. So that, in simple terms, that is what we see.
Thank you, Governor. We do have two more questions. One is a follow-up on the FATF grey listing, and it basically asks that we do hear what you're saying, Governor, and that you are saying you are confident that all the role players will address the findings of the FATF to get off the FATF report and getting us off the list. What about entities that are in law enforcement? Are we confident in terms of their ability to assist us in this process? And then the second question is around the common scenario stress testing. Can you give us more details on the scenarios for the stress tests, if possible? Thanks.
Okay, very quickly, and the team might just add. Law enforcement, I think that what is clear is that the government is committed to getting us off the grey list. And the message from the center of government is that everyone have got to do what they are supposed to do to make sure that they have addressed the shortcomings that are within their areas of responsibility. The National Treasury is doing a very good job coordinating our efforts in addressing these issues, and they actually led the South African delegation that attended the recent FATF plenary. The scenarios that were done, in broad terms, there were three scenarios. There is a baseline scenario, that is, if things are as they are now. The second scenario is what is called an adverse domestic scenario. And in that adverse domestic scenario, what you have is that you have a shock that impacts on the financial sector, that results in growth contracting significantly. As a result of that, the exchange rate weakens, and because the exchange rate has weakened, inflation rises, and because inflation rises, you end up with a situation where monetary policy have got to respond to address the rise in inflation. And that is then applied to the systemic banks in our space to see whether they are resilient to such a shock. And once again, they were found to be resilient. The third scenario is what we call the adverse global scenario. And in this scenario, you have got a contraction in world GDP. You are faced with a situation where emerging markets are under pressure. They experience capital outflows, and because they experience capital outflows, their exchange rates depreciate, and you then have a concoction of depreciated exchange rates, capital outflows, and at the same time a rise in inflation. And even in that scenario, we found that the South African banking system is resilient enough to be able to withstand that. In all these scenarios, we are working on a 3-year time horizon to assess the impact over a 3-year period to see what the effect on the financial sector is. The details are in Chapter 3 of the Financial Stability Review, but just in case I might have misspoken, the stress test team is here with us. Is there anything you would like to add to, any color you would like to add to the 3 scenarios that we had identified?
Governor, I think you've covered it quite well.
Wafa, you are happy?
Very, very happy, Governor. I think the only thing to maybe add is that, in terms of the domestic shocks that we assessed, one of the key considerations there was also a significant escalation of the current electricity crisis in South Africa, and to see whether or not the sector would be able to withstand those as well as part of that domestic scenario. But you've covered the rest very well. Thank you.
Thanks, Governor, and thanks, Vafa. Just a follow-up also on the stress testing question, given that you've just responded to it, Vafa and Governor. The question is, the stress test did not include the smaller banks. Does that mean we remain confident in their ability to withstand shocks? And then I'm going to move on to two more questions. The one question is from Dibuo Nechitenze, and the question is, has there been any assessment of the consequences of implementing a positive CCYB? Does this not equate to policy tightening, negatively affecting already weak economic growth? And the final question talks to inflation. So inflation risks remain given geopolitical risk and other factors. Do you expect to see inflation ease in 2024? Or when do you see that? When do you think it will happen, if not in 2024? Thanks.
Vafa, there is no free lunch here. You're going to have to deal with the stress testing of the smaller banks. I'm sure I can tell you're going to say that you have dealt with 92% of the banking assets, but just give some color there, and also deal with the issue of the positive CCYB in 2025. Inflation risk, DG Kasim, can you deal with that?
Sure, happy to. Thanks, Governor. So, important for us to point out that we are not the microprudential supervisor in this context. We are talking about financial stability, and from that perspective, our focus and our emphasis is on systemically important financial institutions. So the CSST does not include any smaller institutions. As the Governor has indicated, 92% of the banking sector assets are covered within the CSST and the 6 organizations that we cover. We do not take a position at this point as to whether or not all of the other smaller banks would be able to survive these similar scenarios. It's not part of the scope of what we are covering. However, these institutions are obviously also prudentially regulated by the Prudential Authority and are being continuously assessed through a number of different mechanisms from a supervisory and regulatory perspective. And if there are any challenges from that perspective, they will be raised with those institutions through their microprudential supervisory capacity of the Prudential Authority. So from that perspective, I think the immediate answer is that it's not covered in the context of the common scenario stress test. It's not something that we take a view on in the financial stability review. On the implementation of the CCYB, a positive cycle neutral CCYB is something that has been emerging and has been very much discussed internationally and domestically over the course of the last 5 or so years. One thing that became very clear in the context of the COVID-19 shock is that it is important for macroprudential supervisors to have tools at their disposal to be able to assist and ensure the stability of the financial system in times of crisis. Now, the countercyclical capital buffer was designed in such a fashion that if there is a crisis of some sort in the financial system, here is a buffer that you can release in order to, A, ensure that banks can continue to support local lending, B, ensure that the banks have capital on hand to be able to absorb additional credit losses. The challenge with the initial formulation of the CCYB is that it requires a build-up period where there is an escalation of risks over a period of time, and so you build up this capital that can be later released. The reality is, not only in South Africa but in many jurisdictions around the world, is that A, it's very hard to identify the build-up of these risks in advance, and B, that typically when shocks and crises occur, like the COVID-19 shock, it doesn't follow a period of increasing risks typically. So central banks and macroprudential regulators around the world haven't had an opportunity to raise a CCYB in order to be able to release it in times of shock. And so what the Basel Committee for Banking Supervision, as well as a lot of other central banks around the world, have started to think about, and this is now reflected in the decision of the South African Reserve Bank as well, is the need to change where the neutral level is, from being 0% to something that is positive. And in this instance, the South African Reserve Bank has taken the decision to change that level to 1%. What this does is it enables the South African Reserve Bank to, in times of crisis, relax this requirement, free up additional capital for the banking sector, allow them to continue to lend into the market, ensure that they have enough capital to absorb additional losses that may come about if there is a large shock to the system in the near future. So from that perspective, we're quite confident that this provides the Reserve Bank with a double-sided tool, much like several other tools that are at the Reserve Bank's disposal, in order to be able to respond to shocks that don't precede or rather don't follow a period of an increase of imbalances or an increase in risks. So that's the key consideration behind this, and I think that hopefully adequately responds to the question.
Very, very adequate. Does the micro prudential supervisor have anything to add? Fundi?
So thank you, Governor. The only thing that, maybe two things I want to add. So just to complete the question on the health of smaller banks, at a micro prudential point of view, we work on an institution by institution basis. Where we do see problems in institutions, we give guidance on how the problems ought to be resolved. And in this regard, we would say that the entities seem to be broadly okay, and those that have challenges are putting in place remedial actions. So that's the best way to characterize. But given the macroeconomic environment, it is important to flag that the smaller banking institutions, depending on the type of lending that they have, are starting to see strain, as are other larger banks, because we are seeing an increase in non-performing loans during this period of time. But the banks are making sure that their liquidity and solvency levels remain healthy. Maybe, Governor, just to conclude on the FATF grey listing process, just to remind colleagues and those online that FATF works on a remediation process. And so this window that we have until 2025 is for us to be demonstrating. We do report to FATF 4 times a year on the progress that we're making. So hence the comments that the Governor was making earlier, and it is all of the institutions that are undertaking action under the guidance of the Treasury that are reporting back through the FATF process. We are receiving ongoing feedback on what is still lacking, and we are all working to make improvements. And I think 2024 is going to give us the opportunity to further improve in the areas that are still lacking. Thank you, Governor.
Yep. Thank you, Governor. So as many of you know, that in the last year or two, there's been what has been considered a global synchronization of monetary tightening in response to a delayed inflation challenge. And in this global response to monetary tightening, many countries and regions like the EU, the USA, South Africa are not at the inflation targets. Advanced countries who currently more or less have explicit or implicit targets of 2% are not there yet. They expect to be closer to their targets next year. In the case of South Africa, we expect inflation to come down by about 5%, but we only expect it to be at 4.5% for the year in 2025. So many countries, many central banks are optimistic that inflation is on a downward trend, but they are cautiously optimistic because there are all sorts of headwinds around oil prices going in a different direction again, the persistence of food prices. Some countries are not quite sure about whether their labor markets have loosened sufficiently enough to systematically bring inflation down to their targets. I should also add that, in the financial stability meeting, we discussed inflation in a slightly different way. We want to understand what high interest rates means for pressure on households, on firms, and so on. Thank you.
Thank you, Governor DG Kasim, DG Chazibana, and Vafa. So, Governor, I've got 2 final questions. The first question is from Dando Tukwane from Bloomberg, and she asks, how concerned is the SARB about the deteriorating credit quality of lenders' balance sheet, given the central bank's central banks refrain for higher for longer borrowing costs and inflationary risks still linger? I think the question, sorry, let me just read it again. How concerned is the SARB about the deteriorating credit quality of the lender's balance sheet, given the central bank's remain that is that of higher for longer borrowing costs, given that there's higher for longer borrowing costs and inflationary risks still linger? And then the final question, Governor, is on the rand manipulation. So with the recent stories related to the rand manipulation, do you see this as a risk in any way, particularly because there are so many banks that have been implicated in the rand manipulation? Thanks, Governor.
DG Chasivana, can you deal with the lenders' balance sheets?
Yes, so thank you, Governor. I think that, as we talk about what is happening to lenders' balance sheets, it is important to think about this from a system perspective. So we are discussing the financial stability issues today. So if we look at the banking sector as a whole, and what is happening to borrowing in general and impaired advances as a percentage of gross loans, gross advances, they currently are sitting at about 5%, around 5%. Now, if we start to then look at an entity by entity basis, that will vary depending on the size of the banks, also depending on the type of lending. So it varies across portfolios. The important thing for us at a stability point of view is to see whether the non-performing loans are starting to erode the capital within the entities and the capital levels remain healthy at present. The bank credit committees are looking a lot more closely. The banks are also looking to modify on an ongoing basis how they lend. So we think that the banks are taking the necessary steps to make sure that the non-performing parts of their loan book are being carefully managed. And that does not have a system-wide impact at this point in time. Banks, of course, are working with their customers to see how best they can assist them, given the current macroeconomic environment. And this is something that we would look at a micro-prudential basis. And this will differ from bank to bank in terms of the approaches that they are taking in this regard. But the most important takeaway today is that there is no system-wide risk that is related to non-performing loans. Thank you, Governor. Back to you.
Thank you. The story about the rand manipulation becomes an interesting one. For all intents and purposes, this is old news. This is something that allegedly took place between 2007 and 2013. Yes, there are a number of banks involved, 28 of them, but lots of them are not even South African. Point number 3 is that the period referred to also coincided with fairly interesting events and developments in the markets. Between 2007 and 2008, you had the global financial crisis. So trying to disentangle the effect of the global financial crisis on the foreign exchange market and the impact of any alleged manipulation becomes an interesting and a challenging one. But let us look carefully. In that period, between 2007 and 2013, in 2007-8, you had the global financial crisis. Currencies of emerging markets depreciate as a result of that global financial crisis. By the second half of 2009, into 2010, emerging market currencies were strengthening, including the rand. The period between 2009 and 2012 coincided with a period of significant rand strength, so much so that during that period, South African exporters were actually screaming at the Treasury and at the Reserve Bank saying, do something about the rand is too strong. So the notion that would say that as a result of the manipulation, the rand became precipitously weak is not backed by what we have seen in the foreign exchange market. Interestingly, the biggest move in the currency came in December 2013 and into 2014, and that period coincided with the taper tantrum, and the taper tantrum led to a move in capital from emerging markets to the developed markets. And in that period, there was a realignment also of exchange rate. And so we've got to be looking at that. But let's start this thing, and let's say this thing took place between 2007, 2013. The rand did depreciate subsequent to that. But there were important things that were taking place. There was, of course, the Nene Gate in 2015. Of course, there was the COVID shock. But interestingly, during the COVID shock, South Africa was removed from the World Government Bond Index. And it goes without saying that if you are removed from the World Government Bond Index, you are going to experience capital outflows. And with those capital outflows, the exchange rate is bound to move. So it's actually a very complex picture. But let's also be clear that to the extent that the banks got engaged in misconduct in the foreign exchange market, it is something that we have got to condemn and something that we have got to deplore. Globally, what had happened from 2015 was that, given that it was not just in the foreign exchange market, there was also the benchmarks of interest rate where it was, such as LIBOR, where it was felt that the fixing of prices there were not reflective of the true state of the market. And as such, regulators embarked on a process to reform interest rate benchmarks. At the same time, we participated in a global development of a global code of conduct in the foreign exchange market. You can go onto our website. You will find our pledge there of commitment to the global code of conduct in the foreign exchange market. Of course, at our own initiative in 2015, seeing what the other regulators were doing, we decided to also go and find what was actually happening in the South African foreign exchange market. We tasked a team led by former senior deputy governor, Mr. James Cross, to go and investigate this. And the point of departure was to go and engage with the internal audit departments of all the banks. And it was why engage with the internal audit departments. It's because if there is manipulation in the market, if there is misconduct by officers of any particular bank, the internal audit function becomes interested in that because it is their duty to pick up these things, one, and two, to try and prevent fraud. And from the allegations that are coming from this chat room, of course, we didn't have the power to get into the chat rooms, which is probably why we couldn't find anything, because we worked with what was available in the banks. I don't think that any of the banks themselves, the leadership or management of the bank, had anything to do with, well, they were not part of these chat rooms, but these were their employees who were doing these things. And so we became very clear that our point of engagement is with the control functions of the banks. And based on that, we didn't find anything. During that period, as we finalized our report, and you can read the report, it's a 2015 report, you can read the report. It says that during the compilation of the report, it came to our attention that the Competition Commission was investigating allegations after they had been alerted by the Department of Justice in the United States. And so it was clear. So it became a competition issue. It's a market manipulation issue. It's a market abuse issue. It's a collusion issue. It's a cartel issue. That is for the Competition Commission to investigate. The Competition Commission engaged with us as the Reserve Bank. We provided them with all the assistance that we could provide them to facilitate their investigation. And at this stage, we must accept that the Competition Commission is a competent authority on this matter. There is a process that is currently underway that involves the institutions that are accused, and that process has been running. It must be given a chance to unfold and reach finality. And the Competition Commission must be given the space to do their job in pursuance of their mandate.
Thank you, Governor. I had said that was the last round of questions, but we have two questions that snuck in from YouTube. The first question, Governor, is, Governor, what risk do you see to the financial system from the scenario where the Reserve Bank transfers large parts of GFECRA balances to the Treasury? And the final question, Governor, is from John Mills on YouTube. And the question is, can the good governor withstand the inevitable pressure of the spendthrift politicians with an election coming up?
DG Kasim, can you deal with GFECRA? And I can say that the governor does not get engaged in a wrestling match with the politicians. And the governor does not allocate national revenue. National revenue is allocated through a budget process, and the Minister of Finance is the competent authority who has to resist that if there is resistance that has to take place. But DG Kasim?
Yeah, thank you very much. I think that our starting point of GFECRA is that there is a law that governs the accounting and balance sheet transfers between the SARB and the National Treasury. So first to state that this is not anything other than the fact that as part of normal business, there's a law that states what the role of valuation gains and losses are in the balance sheet of the SARB versus that of government. I think that the real question is the perception that has come about, will GFECRA lead to a reduction of our foreign exchange reserves? If it does that, that is a risk to our kind of vulnerability. Is there a perception that GFECRA is an attempt to kind of dig into the balance sheet of the SARB? That could be a risk. But I think that all I want to say is that it's not an obvious risk other than the fact that there are laws governing what happens with transfers between the SARB and the Treasury. There are laws governing what happens with profitability. The year the SARB makes profit, we transfer money to the Treasury. There are laws governing the fact that when the SARB lends up in negative equity. There are laws about recapitalization of the SARB balance sheet, and we really act within that legal framework and accounting rules. Thank you.
Thank you very much, Governor and DG Kasim, as well as DG Chazwana. I think we are done with the questions. Just to announce that the next FSF will take place on the 5th of June in 2024. And Governor, I'm going to hand over to you to say goodbye to our online participants and media and financial sector stakeholders. Thank you.
I thought that is the job of the program director. But thank you very much, everyone, for attending. And all that is left is for us to wish you happy holidays, Merry Christmas, and a Happy New Year. And that we will see you in the new year. Yolanda said the Financial Stability Forum will be in June, but hopefully we will see you before then because we will have the monetary policy review earlier than that. Thank you very much for your attendance and for your interest in the work of the South African Reserve Bank.